Greetings from 3Edge Asset Management, and welcome to another edition of the 3Edge Weekly Update for the week of August 10th. I'm Fritz Folts, Chief Investment Strategist at 3Edge, and I'm pleased to be joined here once again today by Steve Cucchiaro, Chief Investment Officer and President at 3Edge Asset Management. As we do each week, Steve and I will provide a brief update of the global capital markets, and then we'll focus on a particular topic that we believe is relevant in terms of understanding the possible future direction of the global capital markets during this extraordinary period of time. And today, Steve will be providing the latest update on the COVID-19 global pandemic from the IHME, where he serves as a member of the board. He'll also be taking a look at the massive buildup of government debt, which has been exacerbated by the economic toll of the global pandemic. But first, let's get caught up with the global capital markets. With just 3 weeks left before Labor Day and the official end of what has been a fairly surreal summer, this week saw U.S. stocks continue to hover around their all-time highs as equity markets continue to be driven by a combination of momentum, improving economic data, albeit from very low levels, supportive monetary and fiscal policy, and a seeming belief on behalf of investors that there's going to be a positive outcome from the coronavirus, and including development of an effective vaccine in the near future. Unfortunately, none of those things are a given, and so time will tell. And so it remains to be seen whether the ongoing disconnect between the market continuing to move higher and the struggling economy will continue. Just a couple of pieces of economic news. The important initial and continuing jobless claims report this week showed that the number of Americans applying for unemployment benefits fell below the million mark for the first time since the pandemic began. As we all know, negotiations in Washington over continued fiscal stimulus are not going well and basically have fallen apart for now. One interesting note, this week saw U.S. Treasury Auction struggle and U.S. Treasury yields rise. And the rise in Treasury yields helped spark a sell-off in gold. However, gold is now stabilized and remains among the best performing assets on a year-to-date basis. So let me bring Steve into the conversation here, and let's turn our attention to the COVID-19 global pandemic. So Steve, I know you're a member of the board of directors at the IHME, Institute for Health Metrics and Evaluation. So perhaps now is a good time for you to share the most recent projections for COVID-19 by the IHME for the remainder of the year.
Well, thank you, Fritz. And the IHME does have projections that go through December 1st. And I did want to take this time to share them because they're really quite interesting and connected to the idea that COVID-19 does seem to have seasonality. There's a lot more data now that we can analyze. It's becoming more certain that there is a seasonality component. And this could be something that the markets are not aware of, that people are not counting on. As you mentioned, there is a cautious optimism that perhaps cases per day and deaths per day are peaking here and things are starting to get a little bit better, and maybe things will continue to get better until we get a vaccine. But what I'd like to do right now is turn to a chart that shows the total deaths in the US from coronavirus from the past out until we get to December 1st. And you'll see on this chart that once we get to the current time, it branches into three different curves. The lower curve is the best case scenario, and that describes if 95% of the people in the US began wearing masks today. Deaths would really stabilize here and actually go down slightly in terms of the rate of change. And then later in the fall, in getting closer to winter, we start to see an uptick again. And right now, deaths per day, total deaths are about 165,000 so far. And what we find is that in this best case scenario, deaths per day will reach about 225,000 by December 1st. Now let's take the middle case, which is that we don't get 95% of the country to start wearing masks immediately. But we also have a situation where different counties and different states don't open prematurely before their guidelines suggest. And that's a base case, kind of an in-between case. Mm-hmm. And there we see deaths continue to rise, not accelerate, not come back down, but it gets a bit worse by the time we get into the late fall. And the projected deaths now in the space case are a little over 290,000, which is certainly quite a bit higher than now. And it shows that if people wore masks, lots of deaths would be prevented. And then most distressing is this third case. The third case is if we have counties and states that ease in advance of what the guidelines might suggest. Mm-hmm. There we have an accelerated ramp up in deaths. And by December 1st, we have deaths totaling about 385,000, which is a big climb from here. Now, just to put this in more perspective, let's just turn to deaths per day. It's a little more dramatic. And as we know, we've been running as a country on average about 1,000 deaths per day. And that's started to stabilize here. It hasn't been climbing lately, and that's given some people hope. And what we find is in the mask wearing scenario, deaths per day could drop by half or even more than half, but then start to tick up again with the seasonality of the coronavirus. Base case is that deaths per day are a bit volatile around 1,000, and it's not till later in the fall where they tick up. And then the worst case scenario is when there's easing in advance of what the guidelines suggest. Deaths per day could accelerate quite rapidly and go from 1,000 a day to a terrible 5,000 a day. So the big takeaway we have here is that most people are cautiously optimistic that we've seen the worst, and that it is true that we're in the favorable part of the coronavirus cycle, which is most correlated with the pneumonia cycle, which gets better and better until late August, early September. So we could start to see more encouraging news over the next few weeks. But then starting in September, assuming we stay correlated with the pneumonia cycle, things could get worse. And if we don't have a very low level of coronavirus by then we have the potential for an accelerated set of cases. And again, we don't think that that's baked into the market.
Okay, that's a fairly sobering projections, certainly. And let's hope that mask wearing does become adopted more throughout the country, because that would certainly seem to help us out as we go through the remainder of the year. Let's switch gears here now and look at the most recent rise in government debt, which has really spiked recently and has clearly been exacerbated by the economic fallout from the coronavirus and the global pandemic. And it certainly appears that the capacity to control the virus would be essential to create the kind of economic growth necessary for the government to finally begin to pay down this mountain of debt that has been created. So I suppose this also begs the question, well, what if we don't get that economic growth? We don't get that rebound in fairly short order. What becomes of the mountain of debt, which, by the way, as you know, belongs to all of us? So maybe you could help inform us on that piece.
So what's so true, Fritz, is that whether it's the Democratic Party, the Republican Party, whether it's other countries, governments all over the world have stopped caring about deficits and debt. And the solution to every problem seems to be, well, let's borrow more money and spend the money. And because interest rates have been so low, governments have been able to do that with very little pain so far. But the fear is that there's a moral hazard to always relying on being able to raise more and more debt. And one of the metrics that we like to see that's been very reliable over history to gauge when a government starts to get into trouble by piling on too much debt is to compare the level of debt that the government takes on with the size of its economy. And that ratio is simply the debt to GDP ratio, GDP representing the size of the economy. And what is true is that as the debt piles on, once the debt exceeds a certain debt to GDP ratio, many studies have shown that it becomes, as you alluded to, Fritz, very difficult for a country to grow its way out of the debt. So we'd like to show this chart, which shows how the debt has been accelerating. Now, we go back to the financial crisis of 2008, and everyone hoped that we learned the lesson, not just us, but other governments too. We all learned the lesson that we had too much debt, it caused problems. And usually there's a cleansing process that follows, so we don't make the same mistake again. But instead, as you see, debt has just climbed ever so much since then. And this chart only goes through when the government data is available. So it doesn't include the very recent past, and it does not include the forecast.
Right.
It's a forecast by a rating agency called Fitch. And they recently came out with a forecast that said that the debt to GDP ratio, based on everything that's happening, will soon exceed 130%, which is a really important number. Even more recently, the IMF just came out with a forecast saying that by next year, the debt will exceed 140%. Two very extreme numbers. One thing we know, looking at history, is since 1800, there have been 51 times when a government's debt level has exceeded 130% of GDP. And of those 51 times, in 50 of the cases, we've had some kind of a default. And the default either being outright the government couldn't pay the debt, which won't be the case in the US because we can, we're the reserve currency, we can print our own money. Or the default means that there was a big uptick in inflation. And one way to get out of debt is to inflate your way out of the debt. Or the third is that you have a currency devaluation, which is kind of a monetary inflation. It means that people now suspect the value of the currency because you're just taking on more and more debt. You're relying on your ability to print the money, and the money becomes less valuable when you do that. So this is getting to be what we think is a dangerous situation down the road. And again, this might not be really covered in the market. If there's sufficient growth to pay on the debt, then what do? Well, the reason why there might be insufficient growth is that taking on debt is nothing more than borrowing from the future to pay for what you need in the present. And when you grab from the future to pull it into the present, you have less money to spend in the future, all else being equal. So if we can't grow our way out, what do governments do? Well, one idea is to raise taxes. And it's harder than one thinks. One can raise the tax rate, but if we're in a recession, you can raise the tax rate, but it doesn't mean the government actually gets more tax revenues if growth is slower. Then secondly, governments can try to inflate their way out. And we know that the Fed is trying really hard to stop the deflation and cause some inflation. And in fact, came out and said they'd be really happy if the inflation exceeded their target because it's been below their target for so long. And they promise not to raise short-term rates and chase it. So we could eventually get inflation that people hadn't expected. And just a couple of days ago, we saw an uptick in inflation. And finally, what we think might be the most likely case is financial repression, which happened the last time debt got this high in the US, or close to it. It happened in World War II. And what the government did was it got the bondholders, people who lent money to the government, to in fact subsidize the government by artificially holding interest rates below fair market. And so for us, our clients will notice that we are at our minimum level right now in bond investments. We don't want our clients to be among those that are subsidizing governments or companies that are overly indebted that are getting unfair interest rates at the present moment. So it's something that's on our radar screen, something we're aware of. We think the market is being a bit complacent, but we think it's very important.
Quick follow-up question.
Yes.
The the U.S. Treasury auction this week didn't go very well. Do you think that's an indication of potential trouble ahead?
Well, as a U.S. citizen, I'm a little frustrated at the timing of the auction of the 30-year bond. It didn't go well. It was a 30-year bond auction. And where we're taking on so much debt, earlier when we raised money, I would have loved to have seen us take advantage of historically low rates, lowest in the history of the country, and borrowed at longer terms so that we could secure as a country those low rates. And if rates went up in the future, we wouldn't suffer as much. But a lot of the borrowing we've done until today, in fact, until very recently, a lot of the borrowing we've done has been at the very short end. And yes, we saved a little bit of money because short interest rates are even a little bit less than the long rates. But it could be, looking back, a little bit penny wise and pound foolish, where by saving a little bit of money in the short term, we could have saved a whole lot more money in the long term if we borrowed even more money when the bond yields were continuing to go down and locked those in for 30 years as a government. Now we came out with this 30-year bond, but shortly after, markets starting to tick up and yields started to tick up more than what they were just a couple of weeks ago. And so I hope we didn't close the window on that, because we need to borrow more money, and now it occurs to the Treasury to try to borrow more longer term basis if we don't have the demand there. And today was an indication that maybe the demand might not be there. We might have some trouble that we cannot issue as much debt as we'd like. We'll have to call even more on the Fed. They'll have to print even more money, and then we get into this spiral.
One last question. It may end up on the cutting room floor because of the time left, but you mentioned Fitch and their projection of debt to GDP. When they did that, they also downgraded U.S. debt. Is that right?
That is right. So what they didn't do is downgrade the quality of the debt today. What they did do is downgrade the outlook. So what they're trying to say is, look, the U.S. has no problem paying their debts now. They're AAA credit. They're as sound as any government today. But with current trends, their fear is that soon, and by as early as 2021, the debt to GDP ratio will get over certain thresholds, which will mean that there will be trouble ahead. And if it was another country, they'd be worried about defaulting on the debt. With the US, they'd be worried about a devaluation of the currency, a shakiness in the reserve status of the currency, or maybe inflation, which is not good for bondholders.
Excellent. Steve, thank you again. Always very insightful, always learn something when we make these videos. And that will do it for us. Steve and I will be back again next week with another edition of the 3Edge Weekly Update video. Remember, all of our videos are available on our 3Edge YouTube channel, and please feel free to subscribe to our channel and to share these videos with anyone you think might be interested. In addition, if you have questions or suggestions for a future topic, you can send those along to us at our website, which is the number 3 followed by Edge AM, so it's 3edgeam.com. On behalf of Steve and everyone at 3Edge Asset Management, urge everyone to remain safe and healthy in these last remaining weeks of summer. And Steve, thank you again for your time and your valuable insight.
Thank you, Fritz.
And thank you all for listening.